So welcome back to Managerial Accounting. The purpose of this little mini lecture is to review the multiple choice portion of your exam number 2. As you see here on the screen, the multiple choice questions were worth 40 points. So there was 32 questions. So you're going to see a little fraction on the front page of your exam, which is going to take the number you got correct divided by 32. That gives me a fraction. I multiply by 40 points, and that gives you the number of points you scored on the multiple choice part. I'll do a separate little mini lecture on the 6 problems, which were all worth 10 points apiece. So the multiple choice questions are followed chronologically. So the first, you have questions from chapter 8, questions from chapter 5, chapter 6, chapter 7, chapter 8. Remember, I had recommended that your preparation for these, that you do the diagnostic exercise for each chapter, and then also you take advantage of the extra practice that was given to you where we added questions in the additional multiple choice questions for each of the chapters as well. If you did that for this exam, hopefully that bore fruit. If you didn't do it for this exam, then please do it for the next exam. You know, the definition of, I hate to say use the word stupidity, maybe I'll use the word insanity, but is to do the same thing over and over again and expect a different result. So if you're looking for ways to improve your multiple choice score, and most of you did better on the take-home part than you did on the multiple choice, I strongly encourage you to do the diagnostic exercises and to do the practice multiple choice questions as well. So without further ado, let's get into it. So these questions here are from chapter 5. So the question is, which of the following explains why it is misguided, the approach that they use? And the approach that they use is they're tempted to consider support department costs to be facility level costs that do not need to be applied to products. So what's wrong with that way of thinking? What's wrong with that way of thinking is that product costs may be inaccurate because support department costs may be used more heavily by some products than others. This is why we want to allocate support department costs to products, because each product may require more support costs than others. So the faultiness there is in part C, the faultiness in the thinking. 2, joint costs are inseparable. Remember the story of Elmer the pig up in New Hampshire there? These are the costs that are incurred before Elmer went off to be dressed, before he came back as sausage and ham and pork chops and other things. All those costs incurred before the point of split off would be called joint costs. So joint costs are inseparable before the point of split off. So the answer there is A. 3, which of the following are the 4 common methods for allocating joint costs? Well, the 4 common methods are market value at split off, physical units method, weighted average method, and net realizable value. Those are the 4 methods, each of which we explored in class. So the answer there is C. Number 4, under the net realizable method, which of the following equations is used to compute the value of products not processed beyond split off? So I made a little error here. The actual, in my my answer key here, I say C, but the actual answer is A. Which of the following equations used to compute the value of products not processed beyond split off? So if it's not processed beyond split off, then its net realizable value is sales price at split off times quantity. So the answer there actually is not C. The answer is A, and that's the answer I used when I graded your exams. So pardon my error here. I should have highlighted A, not C. 5, which of the following is a drawback of using a single plant-wide rate to applied overhead costs? Well, the reason you don't want to use a single plant-wide rate is that the single driver, whether the hours, machine hours, number of employees, square footage, whatever, that may not be appropriate for every type of overhead. So you want to come up with different drivers for different types of overhead. So the answer there is B. Number 6, which of the following explains why it is difficult to apply support department costs such as janitorial costs to products? Well, you can do this by process of elimination. It's not so much that it's difficult to measure cost. It's not so much that cost cannot be quantified in the general ledger, and that support department costs are hard to define. So by elimination, the best answer is C. But if you look at the C on its own, appropriate cost drivers are difficult, if not impossible, to determine. So the best answer there is C. And again, anytime you do a multiple choice, you can make a case for some of the answers, but if you're given an alternative, like in the last election, we were left with a binary choice, either Harris or Trump. So when it comes to multiple choice questions, in this particular exam, you got to pick the best of the four answers. Number 7, Woodbridge manufactures food-grade wax-lined paper takeout containers. So we make takeout containers for the food service industry. Which the following is most likely a support department course within Woodbridge? So if we make containers, so deli department, sandwich department, salad department, those are likely to be different production departments. The one which is likely to be a service department, support department would be B, janitorial. 7, which of the following statements is true about the sequential method of allocating department costs to production departments? Well, we know the direct method doesn't recognize one support department's allocation to another support department, but the sequential does. So the sequential method captures some, but not all, the interdepartment by allocating support departments to other support departments and production departments in a series of steps. So the sequential method, if you've got, say, 2 support departments, janitorial and cafeteria, first we'll allocate janitorial to cafeteria, and then we'll take the expanded amount of cafeteria cost, which includes the original cost plus their allocation of the janitorial cost, and then we'll apply those to the others. So we capture some, but not all of the interdepartment service costs by allocating support departments and production departments in a series of steps. So that is the sequential method. We know the most accurate method, which we didn't go over because it's too complicated to cover in this course, we just don't have the time, would be the reciprocal method. Number 9, most operating decisions management focus on a narrow range of activity. The narrow range of activity in which the certain costs can be classified as fixed, and we can come up with a good estimate of the variable cost per unit. That's called the relevant range. You want to be on the relevant range. You go beyond the relevant range, then the allocation of the estimate of the fixed cost to the variable cost per unit is no longer valid. So it's relevant range is the answer there. 10, the point where the profit line intersects the horizontal axis on the profit, where the profit line intersects the horizontal axis on the profit volume chart, that's the break-even point. That's the break-even point. So remember when we do the chart of the volume profit volume axis chart, we basically take volume and we put profit. So the point where profit intersects the horizontal axis on the profit chart represents the break-even point. Okay, if you're confused on that, look up profit volume chart. You'll see that it is indeed the break-even point. Okay, number 11. Technology has fixed cost of this amount, sales price of that amount, variable cost of that amount, and they want to realize an operating profit of 200,000. So this is not break even, this is targeted profit. So to get this, you've got to take the fixed cost plus the targeted profit and divide by the contribution margin, which is sales price minus the variable cost. So you come up with 14,167. Anytime you've got answers that you got to choose from that are numerical, do the calculation first, then go looking for the right answer. So we did the calculation and the correct answer is A. Number 12, which of the following would be classified as fixed cost for a t-shirt manufacturer? Well, electricity cost, hourly costs, cotton and polyester cloth, those are all variable costs. So none of these would actually be fixed costs. Fixed example of fixed costs might be depreciation on the factory. So the reason the answer is none, those are all variable costs. 13. In a cost volume profit chart, the total cost line begins at fixed cost on the vertical axis. So we're doing cost volume profit chart here. We're going to capture the cost. We're going to carry the volume in terms of sales. So we've got 2 axes on there. We got 2 lines that are going to intersect. And the point where the total cost line begins is the fixed cost. So when you do the cost, you've got a point on the axis there that would show your fixed cost, and then it increases on the basis of the variable cost per unit. So if you're confused on that one, go back to your text and take a look or look in your slides at a cost volume profit chart. And the answer there is C. 14. Which of the following would cause break-even point to increase? So remember, break-even is fixed cost divided by the contribution per unit. So which of these would cause the break-even point to increase? Well, if fixed cost goes down, that's going to decrease break-even point. Unit selling price increases, that's going to decrease break-even point. Variable cost decreases, that's going to decrease break-even point. So unit variable cost increases, that's going to increase the break-even point. So the correct answer there is D. As production increases, fixed cost per unit. So remember, fixed cost per unit is total fixed cost divided by the number of units. So as you increase production, fixed cost per unit actually decreases. So the answer there is B. Which of the following is an example of costs that may stay the same regardless of the number of units produced? So that would be straight line depreciation on factory equipment. That depreciation would be the same regardless of how many you produced. A cost that behaves in that manner would be called a fixed cost. So a cost that remains the same regardless of number of units, that would be a fixed cost. And a good example of fixed cost would be C, depreciation on factory equipment. 17, which of the following is a reason for easy identification and control of variable costs under the variable cost method? Costing method, okay. So you can, these are all, they're looking for reasons why it's easy to identify and control of variable manufacturing costs. So variable costs and fixed costs are reported separately. That's true. Variable costs can be controlled by operating management. That's true. Fixed costs as property insurance are normally the responsibility of higher management, not the operating management. So all of those are true. So which of the following is a reason for easy identification and control of variable manufacturing costs under the variable costing method? The answer there is D. All of those are true. Contribution margin is contribution margin divided by sales, or the contribution per unit divided by the sales price per unit. So contribution margin divided by sales would give us the contribution margin ratio. 19, remember my little chart here. I can see it now in my beautiful handwriting there on the whiteboard. If the amount of income under absorption costing will be equal to the amount of income under variable costing when the number of units manufactured is equal to the number of units sold. If there's no change in the inventory, absorption costing and variable costing will give you the same answer because the differentiator between the two is what happens to the inventory. So the answer there is B. Under variable costing, which of the following costs would be included in finished goods inventory? Wages, steel for a machine tool manufacturer, electricity for used by factory machinery. All of those are variable costs. So your variable cost, your ending inventory, would include variable cost. What it wouldn't include would be fixed cost. That would only be under absorption costing. So the correct answer there is D. The amount of income under absorption costing will be more than the amount of income under variable costing when you've got an increase in the inventory. So when the units manufactured exceeds the units sold. And the reason for that, if the number of units manufactured exceeds the number of units sold, your ending inventory is going to include fixed costs, which are not going to be included when you cost out the inventory, ending inventory under variable costing. Now, one or two of you, at least one of you, we had a discussion in class afterwards. You do have to account under variable costing. You do have to account for the ending inventory. Now, the difference is the ending inventory only includes variable cost, but you still have to account for it. So the answer there is A. 22, on the variable cost income statement, the figure representing the difference between manufacturing margin and contribution margin is the variable selling and administrative expenses. So manufacturing margin would be sales minus the variable cost of goods sold. That gives you manufacturing margin. Then you've got to subtract out variable selling and administration expenses, and that gives you your contribution margin. So the answer there is D. Which of the following would be an inappropriate activity base for analysis in a service firm? So a service firm does not manufacture a product, they provide a service. So a lawnmower, a company that mows lawns, a company, if your number, you take the number of customers served, if you take the haircuts given in a hair salon, those would all be appropriate. What would be inappropriate for a service firm is the amount of inventory produced because they don't produce it. Which of the following is required by generally accepted accounting? Generally accepted accounting principles requires us to use absorption costing. So under GAAP, generally accepted accounting principles, the ending inventory cost must include an allocation of fixed costs. Just remember, this is a course of managerial accounting, so we're preparing reports for management to make decisions. And oftentimes, when you're making decisions about production levels and pricing and so forth, it's better to make those decisions on a variable costing basis than absorption costing basis. But absorption costing basis is required for generally accepted accounting principles. Okay. HEDI is trying to decide how many units to produce each month. So remember, the number of units produced each month is the number of units sold, which in this case was 20,000, plus the ending inventory that we want to have at the end of the month. So in this case, is 20% of the following month's sales because they want to know what how much to produce in September. So you want to have 20% of October's inventory. So it's the sales plus the ending inventory minus the beginning inventory. So the beginning inventory is you wanted to have on hand 20% of the units you plan to sell in that month. So if you use that formula, the production is sales plus ending inventory minus beginning inventory, you come up with 24,000, and that is indeed A. Number 6, for March, sales revenue is this amount, sales commission is this amount, salaries is this amount, advertising is this amount, and selling expenses are 1% of sales, and miscellaneous selling expenses are $2,100 plus 1% of sales. The total selling expenses for March are, well, you've got to take all of those things. So the total selling expenses for March, 5% of sales, so sales are 1 million, that gives you 50,000. Sales manager's salary is 80,000. Advertising expenses are 65,000. Shipping expenses are 1% of sales, which is 10,000. Miscellaneous selling expenses are $2,100 plus 1% of sales, and 1% of sales for 1 million is 10,000. So your answer there is 217,000. So the answer is A. 27, lots of information is giving, and they want the amount of deficiency or excess cash after considering the minimum cash requirement for January. Okay. So we're focusing on January here, and the minimum cash required that we're going to have at the end of January is 340,000. And they told us the beginning cash in January was 290,000. So take the beginning cash in January, add to it the receipts, subtract out the disbursements. That gives you $366,600. The minimum cash that they wanted to have on hand was 340,000. So you're budgeting that you're going to have $26,700 more cash on hand. You can have an excess over above the required amount. So the excess is 26,700. So you got to do that in 2 steps. 1, get the cash on hand, which is the beginning cash plus the receipts minus the disbursements. That's your cash on hand. And then subtract out the minimum required cash on hand, and that gives you the excess. If the amount of the minimum required cash was 370,000, then you would have actually a deficiency there. So you might have to consider borrowing. Which of the following is integrated set of operating financial budgets for a period of time? So the integrated set of operating and financial budget would be called the master budget. So the answer there is A. A disadvantage of static budget is that they do not allow for possible changes in activity levels. Remember when we started the chapter on budgeting, which I believe was chapter 8, we started with trying to evaluate a manager on the basis of a static budget. And we found that was really unfair because he actually produced a lot more units than was assumed in the static budget. So disadvantage of static budgets, they do not allow for possible changes in activity levels. So the answer there is C. 30, which of the following estimates the number of units to be manufactured to meet balanced budgeted sales and desired inventory levels? Number of units to be manufactured, that would be the production budget, C. And interesting here, you've got a question that actually relates to a previous multiple choice question. So oftentimes, if you struggle with a multiple choice exam, there's one question that very much relates to another question. So sometimes if you can choose, it's a good idea to look back. Which of the following should be ignored when preparing a cash budget? Well, you ignore depreciation expense when preparing a cash budget because depreciation, remember from financial accounting 1, is not a cash expense. And the primary budget in a non-manufacturing business, key term there, non-manufacturing business, would be the staffing budget. So the answer there is D. Okay, so I hope you found that little review useful. If I gave you too many points on the exam, come see me. And if I made an error, or I made a mistake in giving you points, let me know, and I'll do a separate little mini lecture on the problems. Be well, everybody. Thank you for your attention. Hasta luego, au revoir, adios.